So the second paper will be presented by Gabriele Spada. It's Banks Balance Sheet Cost Monetary Policy and the ONRRP, and it's co-authored with Gara, Afonso, and Marco Cipriani.
Okay, so good morning, everybody. First of all, I want to thank the conference organizers for including our paper in the program. It's always a great pleasure to come to the ECB, and for what I work on, I can hardly think of a better conference than the ECB Money Market Conference. So the title has changed slightly. It's the same paper. Some of you have already seen it. It is that we believe, it's fine. We believe it's just more general than not the UX experience and the NRP that John has mentioned previously in his speech. Joint work with Gara, Afonso, Marco Cipriani, my colleagues from the New York Fed. Usual disclaimer applies. These are our own personal views. They do not necessarily reflect the views of the Federal Reserve System or the New York Fed. So what is this paper about? The starting observation for this paper is that monetary policy interacts with bank regulation. Okay? When I say bank regulation here, what I have in mind is all those types of regulation that introduce balance sheet costs in the banking system. So think SLR, supplementary leverage ratio, all these things that penalize balance sheet expansions financed by debt. Okay? So how does it work? Think of QE. When QE is done by purchasing assets from non-banks, what it does, it expands banks' balance sheets. Okay, injecting large amounts of these very safe, low-margin asset reserves, central bank reserves, into the banking system. And these reserves are going to be backed almost all the times by various combinations of deposits. So what it does, it tightens banks' balance sheet costs, balance sheet constraints. Now, there is a growing literature on this interaction between monetary policy and this kind of bank regulation that looks at bank behaviors, in particular bank lending. So my discussant, Yiming has an excellent paper in the JFE. I encourage all of you to read it if you haven't done so yet, in which he shows that large injections of reserves crowd out bank lending. So in this paper, we take a different route, and we look at the NBFI angle. And specifically, we ask the following two questions. So first, what are the effects of this interaction between monetary policy and bank regulation on non-bank financial institutions? And here, when I talk about NBFIs, what I have in mind are those NBFIs that compete with banks in the deposit market, going a bit back to Franklin's presentation. And the second question is, if these NBFIs have access to the liability side of the central bank's balance sheet, how does this interaction affect the composition of the central bank liabilities? So why do we care about these two questions? Well, I think Franklin's presentation before just set the stage for this. Well, because answering these two questions is actually at the core of addressing the broader, bigger picture question, which is, should the central bank provide access to the liability side of its balance sheet to non-bank actors in the first place? Okay, so think about stablecoin issuers, whether they're fully private or they're asking for access to the central bank balance sheet, CBDCs, even the idea of a narrow bank. All these policy topics we're talking about, they all revolve around the same idea. And in this paper, we're trying to make a simple empirical contribution in that direction by studying how monetary policy and bank regulation interacting with each other affect NBFIs and the usage of central bank facilities. So what do we do exactly in this paper? So this paper is going to be very US-centric, apologies. The sample period that we look at is 2020-2021, so a period characterized by large injections of liquidity, so large QE operations in the response to the COVID pandemic. We are going to need some source of exogenous variations in balance sheet costs, and in particular, we're looking at the SLR. So what we're going to use is this episode that I think Jeremy mentioned also yesterday in his keynote speech, the SLR relief of 2020-2021. What happened then, basically, for 1 year, bank regulators, exempted reserves and treasuries from the calculation of the SLR, relaxing temporarily this constraint. Okay, so we're going to use that exogenous variations in banks' balance sheet costs, which is ultimately driven, however, by the large QE injections. Okay. Then NBFIs. What NBFIs are we looking at? So I said those that compete in the deposit market, and so far, until now in the US, the main competitors are money market funds. And they play an important dual role in money markets in the US because they compete with banks in terms of deposits, offering deposit-like products to depositors, but they're also the main providers of short-term liquidity to banks in the wholesale market. And both roles are going to be key. We're going to look at two aspects of money funds, so the size of the industry, and then their portfolio decisions, and in particular, the decision to invest part in their portfolios in the overnight reverse repo facility at the Fed. So this facility that we introduced back in late 2013, that is open to this important NBFI. Our results, so this is going to be an empirical paper, of course, but also an identification paper. So let's switch gears. what we're showing is that when banks' balance sheet costs go up because of these large injections of QE, of reserves due to QE, well, the money market fund industry grows. And the idea is very, very simple. If your balance sheet costs increase as a bank, you have an incentive to shed deposits, and these depositors will find a way into money market fund shares because they're the closest substitute. Fact number one. Second main result, when banks' balance sheet costs go up, they also have an incentive to reduce their wholesale short-term borrowing, and then their main providers of wholesale liquidity have to do something else with their cash. So they're going to repivot, ceteris paribus, towards the deposit facility or whatever, deposit-like facility that they have with the central bank, in our case, overnight RRP. So those are the two main facts that I would like you to take away from this. We also identify additional drivers of overnight RRP take-up, or this deposit-like facility take-up open to non-banks at the Federal Reserve. And there are interest rate risk and supply of government bonds. So higher interest rate risk and lower supply of T-bills, both are going to push overnight RRP take-up up. So they're going to give NBFIs an incentive to place their cash in an overnight deposit-like facility at the central bank. Okay. So this paper is really grounded in institutional details, so you have to bear with me for a few slides because I have to go over all the institutional background. I know my boss doesn't like all this, but I have to go through it anyway. So let's start with balance sheet costs, supplementary leverage ratio. That's what we're after here. What are balance sheet costs? These are all the costs that penalize, that are proportional to the bank's balance sheet size. So they're going to penalize balance sheet expansions financed through debt. Okay. I would argue that the most important one, at least in the US, is the supplementary leverage ratio. How does it work? It was introduced by Basel III, and it's the ratio between Tier 1 capital and total assets. Okay? That needs to be greater than a given minimum requirement. So what are the key aspects of this object? Number one, the assets at the denominator are not risk-weighted. Okay? So this constraint particularly penalizes balance sheet expansions aimed at financing either very safe low-margin assets or, in particular, safe intermediation. So think of reserves and repo intermediation in the treasury market. That's key. Second thing that I'm going to use for this paper, it's very important for us, the assets of mutual funds affiliated with banks. So several banks in the US sponsor mutual funds, have affiliated mutual funds. Well, those assets are not included in this ratio, the denominator. And this is going to be key, of course. Okay, so let's talk about the relief episode. So on March 2020, again, Jeremy went over this. I don't need to spend much time. You all know that there was severe distress in money markets, in the treasury market in particular. So at one point in March 2020, actually, the Federal Reserve started injecting lots of liquidity in the system. In a month, I think, from early March to April 1st, we injected roughly $800 billion in reserves. Okay? And we kept doing it in April to reach almost $2 trillion of reserves injected in less than 2 months. Unprecedented. It kind of worked, of course, it did work, but at the same time, regulators realized that they were tightening massively the balance sheet constraints of the intermediaries, of banks in particular. So they announced a relief, temporary relief. How does it work? Reserves and treasuries were excluded from the denominator for 1 year. So the relief was announced on April 1st, 2020, became effective, at least for DIs, in June 2020, and it was set to expire at the end of March 2021. All this was announced at the beginning, so the expiration date was known to everybody at the beginning. What was the goal? By relaxing this constraint, the goal was to facilitate bank intermediation basically in the repo market and the treasury market. I want to convince you that it actually had a material effect on banks' balance sheet cost. So here I'm plotting the time series of the SLR for the G-SIBs in the US from 2018 to the end of 2021, quarterly frequency. And first of all, so the two vertical lines represent the introduction of the relief and the end of the relief. So first of all, you see that the SLR goes down, starts trending downward in the first half of 2020 as we started injecting reserves through QE and getting closer to the minimum requirement, which is the horizontal dashed line, 5%. Then, as the relief is introduced, of course, the SLR goes up, so it's relaxed. Banks are further away from their minimum requirement. But as soon as the relief ends, following quarter, the SLR of all G-SIBs goes down back, much closer to the minimum requirement. So that's what we're going to focus on in this paper. We're going to use the end of the relief to make sure that our results are not contaminated by the money market stress of March 2020. And we're going to take the permanent shift in balance sheet cost, basically went up for all banks, as our source of exogenous variation in balance sheet cost. So the end of the relief, SLR goes down for everybody, balance sheet constraints are tighter. Okay, the NBFI part of the story, money market funds, well, as of the end of March 2020, so roughly our sample period, at $5 trillion in assets under management. Now they have almost 8, They're clearly the largest cash lender, except for banks, in the US economy. Two types, government funds. They can only hold government securities and repos collateralized by government debt or agency debt. And then you have prime funds. They can do all of the above, but they can also lend to the private sector through unsecured debt contracts, both financials and non-financials. So you have certificates of deposits, commercial papers, also local authorities through floating rate notes. And those is about the type, so what they can do with their portfolio. So why are they important? Because they're the main alternative to banks in the deposit market for depositors, but they're also the main providers of liquidity in the wholesale market to the banking industry. The kind of institutional thing that I'm going to use in this paper is that 30% of the money funds in the US are affiliated with bank holding companies, okay? And finally, last but not least, this deposit-like facility open to non-banks in the US, the overnight RRP. So how does it work? So it's an item in the liability side of our central bank, of our balance sheet. So through this facility, a bunch of counterparties can invest at the Federal Reserve through overnight reverse repos collateralized by treasury securities, okay? Eligible institutions, of course, banks. Then you have primary dealers, but then you also have government-sponsored enterprises, federal home loan banks that John was mentioning before, and money funds. The rate is set by the FOMC in the communication of the monetary policy stance. And why do we have it in the first place? And the idea, as John mentioned, is that you want to have a firm floor of money market rates by providing these important non-bank money market lenders that do not earn interest on reserves a fixed rate, okay? An outside option with a fixed rate. So, as I said, it's a liability on our balance sheet, which means that if we hold the size of the balance sheet constant, if this liability goes up, reserves have to go down. And the reason is that investment in the overnight RP works through the banking system through custodial banks. Okay? So money funds instruct their custodial banks to make the transfer. This is the overnight RP take-up over time. We saw it already, so I don't need to spend much time about it. Volatile. It can be very material in size, from a few $100 billion up to more than $2 trillion if you extend this chart further at the end of 2022. It drains, it disappears as we drain liquidity from the system. So we have this object that is very material, this liability item, can be very material, as large as reserve balances basically, and fluctuates over time with the total amount of liquidity in the system. And money funds are by far the main users, more than 80%, 90% during periods of high usage. Okay, let's get to the results. So that was the institutional background. I told you, I apologize for making it so long, but it was kind of needed. So the first result is about the size of the NBFI sector that competes with banks in the deposit market when banks' balance sheet constraints go up, arguably because of QE. So the idea is that increased balance sheet cost give banks an incentive to shed deposits. These depositors will find their way into money market fund shares. We're going to use the end of the SLR relief as this permanent increase in banks' balance sheet cost as exogenous variation. And what's the identification strategy here? The idea is that the effect should be stronger for those money market funds that are affiliated with banks subject to the SLR. Why? It's pretty simple, because banks have an incentive to retain their customers within the same group. And from the customer's perspective, I have no switching cost basically. I have no switch cost. I just move my cash from the bank deposit into the money fund share affiliated with the same group. Before we get into regressions, I'm an empirical person. I believe in raw data. This is just raw cumulative flows in two groups of money funds over time from January 2020 until the end of 2021. Money funds affiliated with banks subject to the SLR and all the others. So standalone, affiliated with banks not subject to the SLR. The blue line is for those affiliated with SLR banks. And as you can see, around the end of the relief, their cumulative inflows started to increase. While for the other group, the cumulative flows were practically flat. The flows started to increase earlier in the first quarter of 2021 because the end of the relief was announced at the time of its introduction. So that's just data, of course, and so we have to do things a bit more formally. So we implement the same identification idea in a regression setting. It's going to be a panel regression at the daily frequency fund level. In a nutshell, on the left-hand side, you have daily flows in each fund. And the main objects of interest are going to be two interaction terms in which your treatment variable, the fund, the dummy, will be a dummy for whether the fund belongs to an SLR bank or not. And you have two time dummies, the quarter before, ahead of the end of the relief, and the quarter right after. You're going to have time-varying fund level control, so to have fund fixed effects and fixed effects. I'll briefly talk about identification. But the main result is in column 1. Basically, in the quarter ahead of the end of at the end of the relief, funds affiliated with SLR banks experience additional inflows per day of 33 million, per day each fund. In the quarter following the end of the relief, the effect is positive but not significant, but it's still 22 million per day per fund. When you aggregate that, since these are just daily levels, daily values, and there are 100 funds affiliated with SLR banks, over 6 months, that's an additional inflow of $360 billion, which is not a small amount. Column 2, we tested the parallel trade assumption is satisfied. In column 3, we checked that it's not something that has to do with being affiliated to any bank. It really has to do with being affiliated with SLR banks. And then we repeated just looking at government funds, which is the largest segment of the industry, to make sure that it was not just a quirk of prime versus government funds. But identification, so how do we actually nail it, in my opinion? Well, we use, again, in institutional detail, a differential regulatory treatment of custodial banks. So custodial banks in our sample are SLR banks, so they're subject to the SLR, but they were already exempt from using reserves in the calculation of the SLR ratio in April 2020 in a permanent way, which means they were way less affected by the end of the SLR relief than other SLR banks. So what I should see that in funds affiliated with custodial banks, the effect is not there, or if it's there, it's very small. And all of the effect is actually in the SLR banks that are non-custodial. And that's exactly what we get with this test. So that's what this table is showing you. There's a second way to strengthen identification, and it's the intensive margin. They say we have data on the SLR of these banks. We know how close they were to their requirement, the minimum requirement. So I would expect that the incentive to push depositors away is going to be stronger for those banks that are closer to the requirement, which means that the inflows should be larger for those money funds affiliated with banks whose SLR is closer to the minimum requirement. And that's exactly what this regression does. You restrict the sample only to money funds affiliated with SLR banks. You use the intensive margin, and you show that for a 10 percentage point drop in the SLR buffer, affiliated money funds get an additional increase of $50 million in inflows per day. Okay? So very sizable. Now, let me move to the effect of balance sheet cost on fund portfolios. So the first part was on size. Balance sheet costs go up because we do QE, so they tighten. Banks have an incentive to push depositors, and this NBFI sector grows. What about its portfolio decisions? The idea, again, is simple, as I mentioned before. The idea is that if my balance sheet costs go up as a bank, I want to reduce all forms of debt. I'm going to push maybe depositors away, but certainly I'm going to reduce the amount of borrowing I do in the wholesale market, so less repo borrowing, for example. And that means that money funds now have to find an alternative. And ceteris paribus, they should tilt their portfolio towards the overnight RRP. So again, we're going to use the end of the SLR relief as this exogenous permanent increase in banks' balance sheet cost. And what's the identification strategy in this case? Well, in this case, it has to do with what you can do with your portfolio, right? So we're going to say that the effect should be stronger for government funds. Why? Well, very simply for two reasons. First, they have fewer investment options. They can either own all the government debt or repos backed by government debt. And secondly, in a more subtle way, because the increase in the balance sheet costs through the SLR for the banking industry is particularly costly when we think about repo intermediation. So doing a matchbook repo intermediation for our banks is going to be particularly costly under a tightening of this balance sheet cost, so a decrease in the SLR. And government funds can only lend to the private sector through repos. So they were particularly penalized. Okay, again, let's start with the data, just raw data. Here I'm showing you the percentage of fund portfolio invested over an RRP in two groups, government funds and prime funds, from January 2020 until the end of 2021. Blue line for government funds, red line for prime funds. So as you can see, basically, until the end of the SLR relief, so the two vertical lines always represent the introduction and end of the SLR relief. So until the end of the SLR relief, the percentage of portfolio invested over an RRP is practically zero for both groups. Okay? However, after the end of the relief, the line for government funds started increasing much more rapidly than the line for prime funds. So the percentage of portfolio invested over an RRP seems to be much larger for government funds than for prime funds. Just data, of course, so let's do it in a regression setting. The idea is very simple. Again, you're going to have daily percentage of portfolio invested over an RRP in each fund, and you're going to regress it against the main variable of interest is going to be the interaction between your fund level treatment, so whether you're a government fund or not, and a time dummy, which is now is the dummy for after the SLR relief because I'm looking at a stock variable on the left. It's just share of assets you are holding in your portfolio invested at the central bank. We have to control for these month-end spikes that you all know about because the effect in relative terms in the portfolio may be different from prime and government funds. And then we're going to have fund level time varying controls, fund fixed effects, time fixed effects. Long story short, after the end of the SLR relief, government funds increased their share of their portfolio invested with the central bank by 20 percentage points more than prime funds. The parallel trend assumption is not violated, so let's talk a bit about identification again. What we're going to do here in the first case is going to be, again, exploiting the intensive margin. Now we look just at government funds and we ask ourselves, okay, which of these guys are going to be more affected? As I said before, those guys that mainly rely on private repos to manage their cash in their portfolios. Because private repo intermediation was the one that was particularly penalized by the tightening of the SLR constraint. And that's exactly what column 3 in this regression is showing you. That the share within government funds, the share invested at the central bank increases relatively more for those guys that were relying more on private bank repo borrowing to manage their portfolio. Added 2 pieces of evidence to make sure that we're after the right thing. So repo rates declined right after the SLR relief, and they went up during the relief, which is telling you it's a demand shock in terms of borrowing, okay? It has nothing to do with the money fund size. It has all to do with the banking side of the story, because prices went up when balance sheet constraints were relaxed, so banks were willing to accept higher rates, but then they went down as soon as the balance sheet cost became tighter again. The other piece of evidence I find very convincing, again, uses an institutional knowledge, a bit of institutional knowledge. There are some repos that can be netted. So this is called the sponsor repo program in the US. These repos are nettable, which means that they take no balance sheet space, they're balance sheet neutral, so they were not really affected by the SLR relief or the end of the SLR relief. So we look at the portfolio of money funds, and we compare those repos that could be netted, so they were not really a cost for the banking system after the SLR relief ended, and all the others. And the nettable repos are flat, as you would expect. All the action is in those private repos that could not be netted by the banking system. So it's really about the banking system and tightening of balance sheet costs. Fantastic. Of course, there are other 2 things that everybody has in mind. Jeremy certainly had in mind yesterday when he talked about the treasury market disruptions. And these 2 things are the treasury market and interest rate risk. So why? So these 2 factors could confound our findings because of the following reasons. So when interest rate risk goes up, so you have these NBFIs, money market funds, they're issuing deposit-like claims on the liability side. In order to do that, you have to hold the debt, right? That's what they do. They hold debt contracts, which means that they're exposed to interest rate risk. When interest rate risk goes up, for example, if we start tightening and monetary policy stands very fast to fight inflation, as it happened around the time a bit later, well, they have a duration risk they have to manage, so they want to shorten the duration of their portfolio. So ceteris paribus, they're going to go to any overnight investment, including the overnight RP. So you should expect larger overnight RP investment in the face of higher interest rate risk. T-bill supply goes a bit the same way. These guys are offering these money-like assets, these money-like claims on the liability side. They're for sure going to invest in government bonds. If the supply of these government securities goes down, they have to find something else. Ceteris paribus, they're going to park more of their portfolio at the overnight RP. Why does it matter for our identification? Because both effects are going to be stronger for government funds. For the same reasons I gave you before, because they have fewer investment options. These are the only things they can do. So we re-estimate everything, including, of course, the interactions of these exogenous external time-varying factors with our treatment dummy at the fund level, so with a government fund dummy, and our results remain valid, they hold. Of course, we also find that both government bond supply and interest rate risk, which is captured here by the MOVE index, are important determinants of overnight RP. But they do not explain away the importance of banks' balance sheet cost. The final thing, and then I want to conclude, we re-estimate everything. So far I showed you the portfolio in percentage terms, right? The portfolio composition. A question for us, and in general for monetary policy implementation is, well, what about dollar terms? If I put everything together, what's going to happen? So we re-estimate our regression setting, looking at dollar investment at this deposit-like facility for NBFIs, for money funds, for net RRP, putting together all the pieces. So the piece that has to do with the growth of the industry, so whether funds are affiliated with SLR Bank, the piece that has to do with whether you're a government fund or not, plus interest rate risk and government bond supply. And what we obtain is that the effect of balance sheet cost, banks' balance sheet cost, on the dollar investment of money funds at the NRP is very material. So after the end of the relief, funds affiliated with SLR Bank invested $1.2 billion daily per fund more, and government funds $7.8 billion. Okay? So the effects are very material and they explain a lot of the take-up. Okay, So here are the conclusions. Higher banks' balance sheet costs caused by large QE injections. Well, they have two effects on BFIs competing in the deposit market. They're going to make that industry bigger in size because investors are going to move from deposits into money fund shares. And they are going to tilt the portfolio of these NBFIs to the central bank if they have access to the central bank. So QE and QT interact with bank regulation, affecting the size and portfolio of NBFIs. And I want to leave you with a question. So basically, going back to Yiming's paper, right? She shows that when you do QE, then you may crowd out bank lending, right? Because of a tightening of balance sheet cost. But now if NBFIs have access to the central bank balance sheet, and these NBFIs are competing in the deposit market, well, banks can actually drain reserves because they can use the overnight RP, if you want, as a safety valve, push depositors away. These depositors will go into money funds. They're going to get bigger. Banks are going to borrow less from money funds, and money funds will have nothing to do than just parking their cash at the overnight RP or whatever deposit facility, draining reserves from the system. So does it improve or deteriorate QE and the effectiveness of monetary policy transmission? We don't know, but I think it's an important question. Thank you.
So then Yiming Ma for the discussion.
That's great.
All right. Hi, everyone. It's really always a pleasure to be at the ECB, to see many friends, new and old. It's also a great pleasure to read and learn from Gabriele's paper, from whom's papers I have really learned a lot over the years. So these are just my thoughts on the paper, but let me motivate maybe just the setting, just to show how important this question really is. I guess for this audience, this is pretty clear. There's really a lot of reserves in the system. This is true in the US. Reserve balances have exceeded 4 trillion once upon a time. They've come down a little bit, but as we heard from Jay Powell, they're going to restart again the increase of reserve balances. So it's definitely something that is here to stay. The US is not alone. The Euro system has even more in total size of the central bank's balance sheet. And so this is a phenomenon that is really common across jurisdictions. So given that, it's of course very important to understand the implications of this large central bank balance sheet. And there's been a lot of work on that. I think the first set of papers on QE have focused on the asset purchases. And maybe many of you in the room have contributed to that understanding. But I think more and more, I think there's a second set of literature that is trying to understand what is the impact of reserve injections in the system. Okay. And so reserves are a special asset because they're very liquid, but they can only be held in the banking system. Right? And so what that means is that if you have one additional unit of reserves, then that is something that has to show up on the asset side of bank's balance sheet. And as Gabriele so kindly mentioned, we have some work on that, meaning that if these reserves take up balance sheet space, and if balance sheet space is costly, then maybe banks can do less of the other things they could have done with their balance sheets, including lending. Now, there's another side of bank's balance sheet, of course, and that is the liability side. And what happens to the liability side depends on who was selling these treasuries or mortgage-backed securities to the central bank during QE in the first place. In the US setting, a lot of the treasuries that were sold were not originally held on banks' balance sheets. So think there's a hedge fund or an asset manager who wants to sell the treasury to the Fed, but the hedge fund doesn't really have an account at the Fed directly. So the Fed is getting a deposit at the bank, and the bank is getting a reserve from the Fed. And what that means is that this increase in QE would expand reserves and at the same time expand deposits. I believe that channel is relatively weaker in the euro area. If banks are holding more of the securities that were sold in the asset purchases, then that means the expansion of deposits is relatively less. Right? But nevertheless, there is some degree to which banks' liabilities are expanding. And Jeremy yesterday alluded to this, and there's some discussion about what does that do to the liquidity demand of the banking system. Does it increase, does it decrease liquidity demand? With some co-authors, also Christian from the New York Fed, we have some work on this recently thinking that, well, maybe the people who are coming in as depositors doing QE are not really the same depositors that have always been in the bank, right? So if people who were originally holding onto securities, these are institutional depositors, these are probably much flightier depositors than your mom and pop investors who were always in the bank. So if that is the new influx of deposits, maybe the resulting deposit base is changed in composition, is changed in degree of flightiness. Right? But that all is to say that this is a literature about how the banking system is affected by reserve injections. And I think Gabriele's paper is very important because I think it also sheds light on the fact that it's not just banks that are structurally changed. It's also non-banks that we want to think about, because non-banks and banks, they are interacting in many important ways. Right? So I see this paper as a very important contribution in helping us understand what is the impact of non-banks when banks are getting a large supply of reserves and when these reserves are counted in leverage requirement, in particular in the supplementary leverage ratio. Right? So that's why I think it's a really important paper. And as Gabriele already very nicely explained, there are two main results. The first one is if banks have a lot of reserves, these reserves are costly to hold, they're going to want to shrink their size of the balance sheet. One way to do that is to cut deposits by offering lower deposit rates, for example, and deposits and money market fund shares are substitutes, so that's going to shift funding to money market funds. Banks can also reduce their balance sheet size through reducing the amount of wholesale borrowing they take up. In the US, one major form of that is the tri-party repo that they are borrowing from money market funds. And if they're borrowing less from money market funds, then that is shifting money market funds' investment opportunity set. And if money market funds now can lend less to the banks, maybe they're going to lend more to the Fed through the overnight RRP facility, which is essentially the Fed is borrowing repos from the money market funds. Okay, so these are the two main results, and I think they're very convincing. The identification, I think, is very clean. So I definitely recommend all of you to read, I think, this important paper. I really don't have anything to quibble about the execution. I think I just wanted to talk about maybe two main thoughts. Usually I have 3 points in my discussion. This time I really couldn't think of a third one, so just two thoughts on the big picture takeaway of the results. Right? So the first one is about how to think about the role of QE versus the balance sheet costs of reserves, right? So the paper essentially is comparing, the effect from banks who are subject to the SRR and those that are not, right? Meaning that to have an effect in the results, you both have to have a large amount of reserves, and these reserves have to be counted in the leverage ratio requirements, right? So I think it will be interesting then to understand, well, how much of what we see in the paper is due to the fact that there are large reserves outstanding, and how much is due to the fact that reserves are costly to hold because of regulatory requirements, right? Because even without regulatory requirements, the bank is doing a portfolio choice where it probably doesn't want to invest everything in reserves. So I think it may be, helpful to shed light on the magnitudes of, which of these two channels is contributing how much, right? So what I mean is, on the asset side, again, you think of QE as an injection of liquidity, an injection of reserves. Even without any balance sheet costs, banks may not want to just hold all reserves and become a narrow bank. So they're going to choose optimally, how to adjust their balance sheets and how much of other assets they're going to hold. Now, that marginal cost, marginal revenue consideration is going to be tilted by regulatory costs, because if you put an additional tax on holding reserves, then banks are going to want to hold fewer in these reserves. And more of the liquidity, you can think, is going to shift it onto money markets funds balance sheets in the form of overnight RRP take-up, right? So in that sense, I think it's helpful to understand how much is this just because there's a lot of reserves, right? And in the figure that you see here, you see the top line, the blue line is the total amount of reserves outstanding, and then the bottom line, the dotted one, is the uptake in the overnight RRP. You can see that they're very positively correlated, right? So how much of this is just because, if you inject a lot of liquidity. The liquidity wants to go and be equivalized across different sectors, and how much of this is because, well, the sector that you're injecting the liquidity into, which is the banking system, is very constrained by the leverage requirements, right? So I think it would be nice to maybe have a breakdown of magnitudes. This is for the asset side. I think this also holds for the liability side. Again, there is this substitution between bank deposits and money market fund shares. And here you want to think that, again, if there's just QE without any regulatory requirements, banks probably also don't want to just keep a very large balance sheet if their investment opportunities are not getting a high enough return, right? Maybe they want to shed some deposits already, right? But now, if you further impose a cost in terms of regulatory leverage ratio on holding a large balance sheet, maybe they want to get rid of even more deposits, right? And so you see that in the bottom picture, which plots the growth in commercial banks' deposits and money market fund shares, you see that in the two QE episodes over here and over here, there's positive correlation. But you also see negative correlation in other periods of time, which exactly is because of the substitutability between money market fund shares and deposits, right? So here, I think it would be nice to understand, to what extent do reserves push money into money market fund shares, and to what extent does the leverage ratio requirement tilt the amount of deposits that have been pushed into the money market fund system, right? I think the results are all there, but it would be nice, I think, to flesh out those magnitudes. Right, so that's the point one. And then point two is maybe about the implication. So I think Gabriele mentioned the first implication that was mentioned in the paper. I think the other one that was talked about is how, because of this movement between reserves, and you can think the overnight RRP facility, the Federal Reserve's ability to efficiently expand and contract the balance sheet may become more limited. So I agree on face value, that is definitely true. I think if you look at how, the infrastructure works, but I think maybe it's good to think about whether the goal of monetary policy should be to exactly control the volume of reserves, and what, the goal of having the overnight RRP was in the first place. Right. So the overnight RRP was first introduced when the US first came out of low interest rate environments, because the worry is that as the policy rates were lifted, that banks would not pass on these rates to money market funds, right? There's lots of frictions in repo markets. Banks have a lot of bargaining power. So, what if the policy rates get raised, banks get raised their rates, but then they don't pass it on? And so the overnight RRP essentially was to tell the money market funds to say, hey, if the banks are not giving you that higher rate, the Fed is going to give you a higher rate. You can directly deposit secured with the Fed, and that also provides an outside option for money market funds to which they can use when bargaining with their banking system. And it worked very well. Rates were lifted. The money market fund overnight rate provided a floor on the system. And so you can think that this provision of the overnight RRP facility, or to have some liquidity supply to the money market fund sector, was to allow the funding rates to be equivalized across the banking system and an important non-bank market, right? And for the price to be equivalized, you exactly need the volumes between the reserves and the overnight RRP to move, right? That was the whole idea, because if you don't have the volume in the overnight RRP and you just have, reserves in banks, it's segmented, it's locked up, it doesn't necessarily mean that the costs will be spread to other sectors, especially if the banking sector is constrained and has bargaining power. Okay, so I think the goal is perhaps at the beginning not to equivalize volumes or to say who has how much in amount, is to exactly let the market determine who has what amount, so that the funding rates across important funding markets can be equivalized. Right? So under that backdrop, I would actually not change anything to the results. I think the results are perfectly fine, but perhaps the takeaway is not that, the overnight RRP or these balance sheet costs makes it difficult for the Fed to control the amount of reserve balances. Maybe we can think of this as that when we decide the amount of reserves or the amount of QE, it is important to consider who has access to the central bank's balance sheet. right? And I think we've heard this potential trade-off here. Originally I thought I think, but now I think this was now mentioned multiple times. I'm more confident in that opinion. I think there's a bit of a trade-off. You can have a smaller balance sheet and more limited access, but then you're more directly targeting a subset of the economy, which is the banking system, and you're relying on those institutions to transmit the rates across. Of course, this works sometimes and may not in other times. So the other way is to do a broader access. So more total supply, but also more direct control on rates. And so there's the larger supply of this broadly defined central bank money. Right? And I think this paper has highlighted, I think, one step of that. Broadly speaking, you can go from bank reserves to bank reserves as the overnight RRP, but I think this is a more broader question because you can also then think ultimately, you have access, to stable coins that are now maybe getting a skinny master account at the Fed, and eventually to even more access by other institutions and maybe even retail, and that will be CBDC, right? So I think this is a kind of trade-off that the RRP has started to illustrate, but I think it's something that is here to stay and that is important to consider. There's one important caveat, and this is definitely last but not least. An important caveat is that the RRP is a safe storage facility. It does not allow these overnight RRP balances to be used as a means of payment. And that is very different from when we think about CBDC and even stablecoin master accounts. And so I think maybe a more refined version of that first line of the interpretation should be that when we decide the amount of reserves to inject in the banking system, we should think about who else has access and who else has access with what kind of functionalities, because both are going to affect how much optimally the banks should be holding, right? So that's all I had. Again, I think important paper to think about the implications of reserve injections, not just on banks, but also on non-banks. And the suggestion is just to think about the effect of QE versus balance sheet cost, how much they each contribute, and also the takeaway, which I think is a very big and broad one, which is we want to think about the system jointly in terms of banks and non-banks, and how much the banks should be getting should depend on who else gets how much of what. Thank you.
So, Gabriele,
And
would
2
you
minutes
like?
just
Yeah,
to,
absolutely.
so first of all, Yiming, thanks a lot for the amazing discussion. Fantastic as always. 2 points, right? So I want to touch upon both the level effect, right? The macro effect. So as some of my co-authors know very well, identifying micro things is much easier than identifying macro effects.
I agree.
And so we thought about it. The truth is that we haven't done it, of course, and we will try. I totally agree. That's the first order importance because we just very narrowly, I told you it's an identification paper. We think identification is robust, is solid, but then the issue is how much of an first order quantitative effect you guys have. So we will try to do it because actually by just seeing the charts you put together, maybe a simple decomposition exercise is feasible without requiring too much effort. Doing it super carefully, honestly, I don't know how easy that is.
No, I agree.
I think it's going to be hard. But point taken, I think that's first order importance. Regarding whether the NRP helps or does not help monetary policy transmission, so the quote that you have from the paper originates from when we started writing the paper, right? It was back in 2022, so a few years ago, and overnight RP was still very, very large. And we were trying to understand why is it so large, so that's how we came to write this paper. And back then, the concern was, okay, this thing is so large, is it going to shrink to zero when we start draining liquidity from the system, as it should, and as it did back then in 2017, but in 2016, didn't reach $2.5 trillion, right? So that was the concern. So that's where that sentence is coming from, right? Say, oh, can it create a problem? Okay, because maybe it constrains our ability to drain reserves from the system. The truth is that I personally, my own personal views, do not necessarily reflect the views of the Federal Reserve System, New York Fed, or not, is that actually it helps. It helps because it kind of goes to ameliorate the issue that you identify in your paper, the fact that QE can tighten banks' balance sheet cost and then can crowd out bank lending or other activities. By providing banks with this safety valve, you're actually kind of making their lives easier, right? Because they say, look, you don't really want deposits, you don't really want to borrow wholesale. All these safe reserves are taking this space in a useless way on your balance sheet. Push it out. Someone else will take that liquidity, park it and drain reserves from the system. So my personal view intuitively is that it's going to help the transmission of monetary policy. That's just my personal view. And on the last comment, yeah, I agree. Two views. You could have probably a linear balance sheet with access only to traditional banks, or you can have a broader, larger, maybe balance sheet with NBFIs too. It's not super clear to me that the first one is necessarily smaller, right? At the end of the day, you still need to provide the banks enough liquidity so that money market rates in which they operate do not spike. So intuitively, yes, but you know, I'm not sure. I'm not sure how much of this is driven by the US experience, which we really went big to fight COVID, and we ended up spending a long time deep in the Bonton region. I don't know whether that's necessary as an optimum in the steady state. Do you know what I'm saying? But it's just my 2 cents.
Super, thank you.
One,
Yeah,
two,
let's
three,
take
four,
questions. Let's start here in the second row.
Hi, Antonio Garcia from Santander Bank. Congratulations, a super interesting paper and also a very illuminating discussion. I learned a lot from both. Just a question perhaps on the policy implication side. You kind of left us with a cliffhanger, but now you gave us a little bit more juice on it, which is it is very interesting. So, look, it is very interesting the part in which how regulation interacts, the access or not of NBFIs to central bank, and that driving your results in terms of the size of NBFIs, the MMFs in this case, and then the change in the asset composition of them. But if we move forward to current situations relative to the natural experiment that you conducted, we are now in this situation in which there's more what we call regulatory simplification in banks, so maybe deregulation. Then there's also obviously an increase in the supply of US treasuries, short term as well. And there's also perhaps, well, if we measure interest rate risk by interest rate volatility, there's way less. So all these issues that you address in the natural experiment is kind of the reverse of it, or the opposite of it. So I want you to, if you can comment a little bit sort of on the policy implications and the current circumstances, whether you actually need even more access to the central bank by NBFIs, not just to the liability, but to the asset side, okay? Whether there's merits into access by some, not all, some NBFIs, maybe UK style, for some institutions to mitigate financial stability issues, so your monetary policy works better and is better transmitted. Are there merits into that, or does your paper speak to this?
So there are 2 parts in this question, the way I say it. The first part is whether what we show in the paper is consistent with the current conditions, and I would say yes. What we identified back then is basically consistent with what you observe now. The NRP disappeared, and it is true that now the treasury supply went up, interest rate risk went down, so all the things that push money funds to invest in the NRP kind of disappeared, and SLR constraint is not probably as binding as before because we've been draining reserves from the system. So that's the first part, which is more of a statement. Yes, so it is consistent, what we observe now with what we identify in the paper, which to me is very reassuring. Now let's come to the tricky part, which is the sort of policy question. Personal views, again, totally personal views. I think that the NRP helps the transmission of monetary policy and the management of our balance sheet because we are in a very specific money market, which is different from the European one, in which money funds are very large. So in the US, money funds are key. So you want to accommodate for that. Now, asset side, I do think that facilities open to non-banks that are key and target really some important money markets that we care about, those are useful. So SRF, I think it's very useful. And I think the example what they did at the BOE was also very useful. So personally, I'm not against it. I think it's very natural. Of course, you have to set some boundaries. Then my boundaries would be what are the markets I really care about as a policymaker in a monetary authority. It's not going to be every market in the world because that's not monetary authority. So those 2-3 markets that I really care about, I want to target specific institutions. Doesn't matter whether they are banks or something else. That's my view. There's Yiming, there's 3, 4. Where do we go?
Okay, Yiming as the host. There's a micro.
Indeed, sorry, I'm using my host capacity. But just to say, Gabriele, I really liked the paper. I think that using this natural experiment of the SLR relaxation during COVID is an excellent way to quantify the impact of regulatory costs to intermediation, and also how this shifts the equilibrium between banks and non-banks in the financial system. So in Europe, we also had a temporary exemption of the SLR during COVID, but we're probably unlikely now to relax the leverage ratio requirements. I wanted to highlight, and there I also invite some of the senior central bankers we have in this room from other jurisdictions that have deep experience of both banking supervision and markets that may want to come in. So Vicky, Makoto, and others. That also shows the link between regulation and market functioning. Okay, and then I have two pointed questions. The first one is, are you able with your model to quantify the difference of impact between the exemption of central bank reserves and the exemption of government bonds from the SLR? And then what about the NSFR? Because in the Basel rule, there was a weight on repos against government bonds on the NSFR. In Europe, we actually, you have a permanent exemption from this in the US now, and there are also permanent exemptions in other jurisdictions. In Europe, we had a temporary exemption that was actually falling in June of this year, yeah. And we did really a lot of work with my teams and also with banking supervision to kind of look at, should we prolong or not? We finally decided to prolong, but if there's any result about whether we did the right thing, that's interesting. Thanks.
Okay, so brilliant idea. We didn't think about it. I think it's feasible. I'm referring to the idea of looking at trying to understand whether exempting reserves rather than treasuries is going to have a differential effect. It's not straightforward, but there could be ways to do it. But just looking at the balance sheet of these banks and see whether they have relatively more one than the other, and then corresponding to that, you look at their both deposit activity, affiliated money fund flows, and borrowing in the wholesale market. So you can basically repeat it, having some proxy for exposure, and you see whether it was more important for banks that were holding lots of treasuries rather than reserves. It wouldn't be clean, but we can try. So we haven't done it, but it's something that we could try and do. Now, regarding the NSFR, right? Yeah, net stable funding ratio. I don't know much about it, so I'm not an expert. What my experience from writing this paper and thinking about these problems is that this exemption was very useful. And so prolonging exemptions similar to this in spirit may not be a bad idea. And the reason why I think it was useful, and I think similar to that in spirit, the qualification means, personally, including reserves in the leverage ratio, to me, does not make much sense. That's my own personal views. Totally personal. So to the extent that the exemption in the NSFR is sort of similar or speaks to the same tweaking of an important regulatory constraint that I understand where it's coming from, things can be improved, right? So if it improves it, improves it.
Great, thank you very much. We have run out of time. I'm really sorry to... Okay, you're the host, and you mentioned Vicky, but all the other discussions, I'm sorry, then later on. Vicky, you go on.
I'm sorry to prolong this. It's just in responding to our kind hostess's very good question. I also really like the paper, and the discussion was brilliant as well. So thank you for that. It is tricky, actually, this interaction between regulation and QE, QT, QN, and the interactions with the central bank trying to maintain monetary control and transmission. Because, of course, there are objectives of the leverage ratio itself, and the objective was it's non-risk weighted, as you correctly said, but risk weights are not perfect. Indeed, we have lots of examples of risk weights failing. And therefore, the leverage ratio was set by regulators in order to have a backstop, quote unquote, that word again, against the failures of risk weights for resilience reasons. Now, we at the Bank of England have exempted reserves from our leverage ratio. And that was done at the time that we did one of our QEs, or asset purchases, in order not to have some of the effects that you described in terms of balance sheet costs. But, I mean, one, we need to think, however, also what the impact of this has. I mean, obviously it increases the demand for reserves, and it decreases the balance sheet costs, other factors being equal. But also, without also exempting Treasury securities from the leverage ratio, it creates an asymmetric incentive in terms of banks extending repo generally to other banks, and particularly to non-banks in the world that repo. So there is another consequence of that. So you effectively need a general equilibrium way to try to understand all of this. And on the fact, which goes back to the debate, if I may, given that I have the floor, that we had about Friedman rule and so on, coming back to Isabel's speech, but also it has come up in other contexts, and also the papers by Vissing Jorgensen, which came up in Franklin's paper. I mean, reserves, are they totally costless? I mean, to supply them, you either need the central bank to take on government bond, so interest rate risk, or the central bank, or the central bank to lend to financial institutions through repo, and therefore take on some credit risk. So you need to think, and by doing so, the central bank takes out certain assets, because the central bank will always lend in a collateralized way, that also have a convenience yield. Mm-hmm. So the Friedman rule needs to be extended for that. And that is also relevant to this debate that reserves are completely costless. Thank you.
So, super briefly or not? Yes. Okay, super briefly. The first part, totally agree with you. My statement was a partial equilibrium statement. I didn't even mention anything about treasuries. I just said reserves should not be there. I didn't say whether I think treasuries should be there or not. The reason why I didn't say it is because it's trickier. Because reserves is just money. It's literally liquidity. Treasuries, they are very safe. People keep saying that they're super safe, but sometimes they're not. And the prices fluctuate. So I can't put them on the same footing in terms of leverage ratio rationale. Of course, if you want to make an optimality statement, it would be ideal to have a GE model in which you take into account the interplay that reserves and treasuries have in money markets more generally, not just from the perspective of being a leverage ratio measure. So I totally agree with you on that. For what concerns Friedman rule, and whether providing reserves is costly or not, again, I agree with you. So Friedman rule is optimal in all these models in which you have no frictions. As soon as you start having frictions, Friedman rule is not optimal anymore. So let's start from that. So it may not be optimal even now. My perspective is that, so we have this paper with John on the optimal supply and all this theory paper. In a sense there we are a bit agnostic, and the idea is that different jurisdictions may have different considerations. Some people care about political economy, independence, excessive footprint. This will position your target somewhere along the curve, which is not necessarily the flat part. And then the question, I think, is each jurisdiction should have its own pseudo-Friedman rule. And then the framework will be what's the optimal amount of reserves and corridor between deposit and lending facility that allows you to achieve the target. So yes, Friedman rule is not optimal in the real world in a sense, no? Almost by definition.
Great. So thank you very much for this lively discussion. I hoped for it, and there we had it. Let's continue in the coffee break. Thank you all.